Pundits often look at the best S&P 500 ETF, but few talk about why you should want to invest in the S&P 500 in the first place. So we're going to compare that method to other methods of getting U.S. exposure. We're then going to compare the 3 largest ETFs in the world by assets under management, all of which happen to be tracking the S&P 500, and we're going to pick a winner. So I wanted to start by talking about a firm called MSCI. So when I was working at Morgan Stanley, I was tasked with running support in a division that eventually had an IPO. It was spun out from Morgan Stanley, and that is now MSCI today. It's a $43 billion company. They're the largest and most predominant provider of international indices. So the accuracy levels of their indices in production are somewhere around 99.96%. So my teams supported these indices along with other tools. Close to $14 trillion in money is benchmarked to their indices globally. They calculate somewhere around 200,000 indices, and they're pretty much used by everybody. So the approach that MSCI takes to global equities is quite interesting and intuitive. So here you can see this diagram by Visual Capitalist, and MSCI has taken a look. It's called the MSCI ACWI, All Country World Index. IMI means all market caps. So MSCI ACWI IMI is a picture of all the stocks in the world. So it represents 99% of the investable global equities market. And of those markets, 23 are developed. So you have like USA, Germany, Japan, and then 27 are emerging. So Brazil, Russia, India, China. And then you also have frontier markets, which are they're even more risky, let's say, than emerging. But this picture shows us something interesting. If you look at all the equities in the world, 58.6% of those are from the United States. So that's about a 59% exposure. Then you have the UK at 4%. Other EMEAs, that stands for Europe, Middle East, and Africa. That was the region that my teams supported, 3.4%. So this breakdown then can be used to look at the United States. You say, all right, let's look at MSCI USA. Well, that's an index designed to measure the performance of the large and mid-cap segments of the U.S. market. They call it MSCI Standard. It has 609 stocks, and it covers approximately 85% of the United States market capitalization. Now, you can also have MSCI USA IMI that includes small caps, but that would just add on, 15 more percent. Now, if the S&P 500 is the largest 500 companies in the United States, then MSCI USA and the S&P 500 should be very, very similar. Turns out they are. So the S&P 500, this describes it well from the horse's mouth, is widely regarded as the best single gauge of large cap U.S. equity. So it contains 500 of the largest companies in the United States and covers, look at this, 80% of the available market capitalization. So the difference between this and that MSCI USA, that extra 5% found in MSCI USA is mid caps, right? Now, S&P also provides a whole slew of indices. You can see here the S&P Total Market Index. That's the same as MSCI USA IMI. It's all eligible U.S. common equities. You see, then you have the S&P 500, S&P Mid Cap 400, Small Cap 600. So the S&P 500 is a tremendous brand. We're going to talk about that. But one of the reasons for that is because it's been used so much to look at historical performance. So this article is quite good from Big Law Investor, and it looks at the compound annual growth rate of the market from 1871 to 2016. And there's also a duration here, 1900 to 2016. And then they adjust that for inflation. And what you can do with this important number is then determine what sort of returns you can expect from the market over long periods of time. It's very useful. So when we look at SPY versus MSCI. So the S&P 500, the largest S&P 500 ETF SPY, versus Invesco's MSCI USA ETF, which uses MSCI USA Index. Look at how the sector weightings are nearly identical across the board. As we said, the S&P 500 is just a great picture of large cap companies in the United States, and there's other ways to get that exposure. It just so happens that S&P 500 has the strongest brand. So what we know so far is that investing in the S&P 500 represents an investment in the USA. Their brand has been tremendously successful. Firms like S&P Global, FTSE, MSCI, these are all index providers whose indices power the world's largest ETFs. Now, let's look at the world's largest ETFs. At the top there you have three: SPY, IVV, and VOO. So an offering from S&P themselves, from iShares, and from Vanguard. iShares is BlackRock. And you see that these three ETFs, largest in the world, total $1.2 trillion in assets. And you go down the list there, you see that the next appearance from a S&P ETF would be their S&P small cap. So ETFs are big money. We just did the quick math here. You can see that for SPY, for example, which now we're looking at fees, has 3 times the fees of the other two ETFs, and it generates for S&P $455 million. And you might ask, well, if SPY has the most assets, how can they do that having the higher fee? Well, that comes down to their brand. And if they have the most assets, they're not consistently losing assets in that ETF. Why should they lower the fees? Now, what else is interesting to note here is because these three ETFs all track the same index, it's S&P's S&P 500 index, 2 of those providers are paying fees to S&P, which happens to be the operator of SPY, who isn't paying fees. So they actually have a huge competitive advantage there in their back pocket if they ever wanted to compete on costs. So what's important to note here, the takeaway, and I also noted the extra decimal places here. Those translate, so you can see where we've drugged those out. That translates to an extra $21.7 million a year for SPY. Just goes to show you how much money they make on these fees. But these transaction fees are the single most accurate predictor of outperformance. And of course, they can change over time. And usually one competitor's choice to change often solicits a reaction from others. But S&P SPY ETF is charging 3 times as much as the 2 largest competing offerings. It means you don't invest in SPY because, again, fees are the biggest predictor of outperformance. And we used VettaFi's database for this video. And you can see here they did this simple aggregation of ETFs in the large cap growth equities category, which is where the SPY ETFs fall under. And you can see Vanguard's average expense ratio, there's 7 basis points compared to BlackRock, State Street, Invesco, all 20 basis points or higher. And Charles Schwab starting to edge in there with 4 basis points average on their ETFs, and probably not very many, as you can see by AUM. But look at the average 1-year return. So it's no coincidence that the lower the expense ratios, the higher the return. So what's important to note here that a lot of people try to do is look at metrics like past performance and yield to compare these ETFs. That's very misleading. First of all, you're always going to find discrepancies in data sources. So we use a lot of data from NASDAQ that we license for our own strategies, and we're always finding issues with that and reporting them. Not always, but over time, there's just at MSCI we had 99.96% production performance, and data issues would always screw us over, usually from exchanges. Now, expense ratios change over time, so it's not fair then, unless they had the same expense ratios going back into time, as far back as the history that you have, it's not fair then to be looking at performance. Although they're all pretty much the same anyway. The metric you need to pay attention to that's missing from most analyses of these ETFs would be the tracking error. So a classic question to ask in finance for an interview, just to make sure the person sitting across from you has some knowledge following their degree at uni or whatever time they spend in industries. What's the difference between active and passive investing? Very simple question. A passive portfolio manager who beats their benchmark, this is not intuitive. So if you were tasked with following a benchmark and you beat that benchmark by a wide margin, you were a passive manager, you weren't competent, you'd be penalized for that. Because passive managers are simply meant to track their benchmark perfectly. Now, you'll never be able to do that. It's called a tracking error, right? The deviation between your return and the benchmark. Now, actives, of course, they're expected to beat a benchmark. 95% can't. But a passive portfolio manager is paid to track a benchmark, and they're judged on their tracking error, which is simply the difference between the performance of an investment and its benchmark. And this article by Vanguard, Tracking Error, the Often Overlooked Cost, talks in detail about that. Now, to start getting into the tracking error conversation, aside from just parroting numbers we can go find in the public domain, you need proper tools to do that. Those are the tools that we built at MSCI. Now, these will come down really to the competency of portfolio managers to a certain extent. After that, you'll be down to rounding errors. Now, what you can then look at is say, well, iShares and Vanguard. So remember, we eliminated SPY. We're down to IVV and VOO. So iShares and Vanguard, probably the most competent ETF providers out there. Vanguard has a reputation for lowering their costs. That's literally how they built their reputation in the industry. So that might take precedent over iShares and BlackRock. Just at the time I was at MSCI, Vanguard was known for always competing on costs, and you can expect them to continue to do that. Now, one thing we haven't talked about that's very important when we think about MSCI ACWI and MSCI USA and your investment in the United States is that, remember we talked about the total global equities, MSCI ACWI? Well, 78% of that would be MSCI World, which is developed markets, and 12% is emerging. So investing in the United States, if you're from the U.S., immediately exhibits domestic bias because you're missing out on a lot of other developed markets that you ought to be looking at. And that brings us to the topic of VOO versus VTI. And I have a very strong opinion about which ETF is the best. To make sure you subscribe because we're going to cover that in a coming video. But of course, you want to know the answer to the question, which is the best S&P 500 ETF? Well, two things to note from this table, which shows the largest asset managers in the world. BlackRock at the top, they have iShares, right? And Vanguard in second place. So we would choose Vanguard simply because of their industry-wide reputation of always lowering costs. And again, going back to that point about expense ratio being the most important predictor, another interesting thing here is on the positions 9 and 10, we have Franklin and T. Rowe. Those both happen to be dividend champions. We actually happen to be invested in one of them. So if you're looking to invest in these strong businesses that generate all this money from these fees they charge investors, then there's a couple options there at least. There's other companies here that are publicly traded. Now, for all you dividend growers out there, we did an interesting piece on dividend growth ETFs. I'm going to put that up here for you to watch next, but please make sure to subscribe to this channel. Thanks so much for taking the time to watch this today.